All right, we'll start off some introductions. I'm Luke. I'm our head of strategic partnerships here. I think this is a panel that's geared around Skylink. We're partnering together with a number of chains to do this, and a lot of the strong partners here. But why don't you guys give a brief on each one of you, and we'll go from there.
Yeah, I'm Cooper. I work on the Injective Labs business team, and I am super lucky to be here with these folks talking about kind of the future of unlocking real-world yields on chain.
Hey, my name is Inder. I'm the VP of product at D3. We're tokenizing pretty much the entire domain industry on chain.
Wait, let me guess. You're from Movement.
Actually, no. Yes, I am for Movement. I run our DeFi, one of the founding team members. I've been kind of running BD, and I'm excited to learn what are the real world yields. I'm looking for them myself.
Hey, I'm Kenny. I lead ecosystem growth at LayerZero. We are live on 120 chains across multiple VMs, and I think we actually work with everyone up on stage here. So super excited for this panel.
Yeah, I think this is a great kind of initiative, right? From our point of view, not every chain wants to be a part of, I think, the RWA movement. And what a better way to do that by linking it through an interop, protocol. We're working through it, LayerZero, on this Skylink initiative, and then partnering with Movement, partnering with D3, Injective, on basically being able to deliver some of those. We have a bunch of Nest products, Nest vaults, and the yield that comes from it, we can actually stream over to different chains, and people have that as a mirror token. Maybe Kenny, you actually want to talk a little bit more about it, being our LayerZero rep here. What do you think?
Yeah, I think it's super interesting, right? I think this cycle we've seen a lot of advancements in how people are driving yield on chain. I think last cycle there was this adage that if you don't know where the yield's coming from, you likely are the yield. I think this cycle we've seen a lot of revenue generation on chain coming from on-chain T-bills, borrow lending protocols, things of that sort. And so I think it makes sense because if you look at value transfer today, it's really stable coins, right? It's a nice safe store of value that is going to be the same value when it gets from source chain to destination chain. And so to have a method of that's accruing on chain is something that I think every chain wants, and that makes sense for a lot of DeFi ecosystems, especially for the folks that want to borrow and lend against a yield-bearing stable to loop yields. We've seen that play out a lot of times too. So it makes a lot of sense why a lot of chains would want some sort of on-chain yield mechanism.
Yeah, just to add on to that, why we're super excited about the Skylink network and being able to leverage such great real-world assets on chain is because we're big believers at Injective that several chains will have several great native issuances. However, we want to be a essentially utility provider for wherever those assets are coming from. So if Plume has some of the best real-world assets, we want to be able to take those assets and plug them into many of our finance-based modules on our chain, such as spot markets, using these different types of assets as a form of collateral to trade derivatives, borrow and lending markets, which we just touched. And I think more specifically, the really interesting piece is then being able, okay, the yield's on chain, the asset's on chain, why did we bring it on chain in the first place? And we're excited about the different use cases and forms of utility that we can provide for those assets on chain. Namely, and excited to get more into it in the panel, I think kind of creating liquidity for historically illiquid assets on chain through different things like central limit order books, AMMs, et cetera.
Yeah, I think this is a really mutually benefit. Yeah, go ahead. I thought you were going to say, but
No, I was just going to say, when you say real yields,
yes.
I'm assuming you mean not from tokens. So from my perspective, there's only two, maybe three real yields. One is T-bills, one is borrow lending protocols, and one is the carry trade that Athena does.
Yeah.
Other than that, everything else is... Wait.
Yeah, hold on. I got a lot to say.
Has not found full product market fit yet.
All right.
Yeah.
Fair.
I'll just jump in for a second. I think it hasn't found product market fit on chain. But I think when we talk about real yield, there are real businesses, and I come to domains, right? It's a $300 billion industry. People are taking loans on domains. People are taking leases on domains. People are doing everything, trading, fractionalization of domains. That's already generating a lot of yield. That's the yield we want to bring on chain. That's the real world yield that needs to compete with T-bills and stable coins. And it can't just be we can't be the yield, like you were saying, Kenny. So I think the product market fit will come when the user experience evolves, but the real yield comes from real proven business models moving on chain, and not just like illiquid RWAs, but real RWAs that could use even more efficiency, like domains.
Yeah, and just to double tap on that, I find it to be a very interesting comment. We work with a lot of the leading trading firms, and they often note that, outside of a few venues, whether that be, I would say, Solana and the meme coin angle, or maybe, let's say, Hyperliquid at the moment, there is very little real yield on chain, meaning real flow, where different forms of market makers who literally make money off a bid-ask spread can actually trade and be profitable and it be worth their time. However, they're incredibly profitable trading across centralized exchanges. And once you lose that essentially visibility or transparency into where are the funds, now they're off-chain. Essentially, I could completely agree here with Rob that there are very limited kind of, real yield kind of opportunities on-chain, but being able to take the ones that are off-chain and offer them on-chain and plug them into composable use cases, I think is really interesting and kind of where we're headed.
Yeah, I think totally to your point, like those are the three things that have done well on chain. I think we just need to deliver a better user experience for people, right? Being able to like get into equities or private credit or things like that. I mean, the yield is all kind of off chain, right? Whether you're talking about the carry trade, which is done through exchanges, or you talk about T-bills or anything like that. Those types of yield opportunities exist, and bringing them on in a way that the user can like just kind of buy into and have a front end that's all incorporated, which is what we're trying to do with our like Nest product, where you're able to just step in, be able to buy it like a couple clicks and not have to go through a lengthy KYC process that no one likes anyways. So I think that's addressing that, can deliver it, but then also like I think partnering with like you guys in terms of like leaning into this RWA narrative, I think is really powerful and synergistic. I wanted to ask you guys, from the chain's perspective, what are kind of like, I used to work at Arbitrum. One of the big things I saw, there are some things I'll share after, but what are your takes on getting people to like get into like real world assets? Is it a thing? Is it challenging? What are your thoughts? Yeah, whoever.
Okay, so I'm not pessimistic. I'm just pointing out the elephant in the room where everyone doesn't just cheerlead, but like, people talk about like putting a house on the blockchain. The reality is that like, let's say you put your house and you tokenize it, and I hack your wallet. Do I just come and say, get the hell out? Right? There's going to be a certain point where the on-chain has to meet the real world, right? But the thing is that like, if you can't enforce it, then it's not real. So that's like the main thing. Now there is, because like for example, there was a big push at one point for like sneakers, where sneakerheads, like they have all these Jordans and all these different shoes, but they're like, man, the inventory, having the storage is such a headache. I wish there was one place I would pay them, they would hold it, and I could just sell it like an NFT back and forth. But the reality was that if someone took your NFT, but like the person who's redeeming it knows it's not theirs, then they have like a conflict of interest here. And then it's like, who do you go to? The police? Like, there's no on-chain police unless you're on Binance and you call CZ.
Yep. I think that to that point, like, yeah, you have to make sure these assets somewhat have collateral. Like, real estate's a good one, but, you have to make sure, like, you're obviously in a legal market that allows you to claim it and take it over and stuff like that, right? So, yeah, totally agree with you.
Yeah, I think one of the things about RWAs, and I think why they found product market fit, is because of the duration, right? Like, last cycle, you look at interest rates held to zero. You had, like, food farms for the first iteration of DeFi that were paying you, like, I don't know, like 20,000% APR. That's just not sustainable, right? And so I think if you look at, like, these on-chain T-bills in an interest rate environment where they're not going to be held to zero, there's always going to be yield that's derived from holding that on-chain. I think that's the key to longevity and why, like, there's, like, entire ecosystem being built out around RWAs now. So I think the biggest thing is just, like, having a sustainable source of yield that is always going to be there and is not going to just, like, be some farm token that goes to zero in, like, a year or two, right?
Yeah, I kind of agree, like, even with you, because domains are already digitally native asset, right? You try to tokenize wine, sneakers. I'm not saying it's a bad idea, but it's logistically a nightmare. Like, that's just the reality. You already custody your domains with GoDaddy and Namecheap. Like, you can literally have a court order and GoDaddy will take your domain away. But at the same time, the way like we're approaching it, we're like kind of locking the domain one-to-one with the token. not just on our side, but enabling the custodian to offer that. So Namecheap can offer you the token. And in reality, if you lose your DNS token, yes, someone can come set the DNS on your domain right away. I mean, it's basically like coming into your house and saying, get out of here. But obviously, you need like the safety net. And going back to your original question, the users don't care about chains. Like every user we have spoken to, all they care about is I want to invest $1,000 in software.ai, or I want to buy like, domains that lead to like 15% yield. They don't care if they're sitting on like, Ethereum or Solana or Base. They don't want to like think about wallets. They just want to tap into that liquidity. And that's what I think platforms like Plume and us kind of like plugging into it, we need to like build together.
Yeah, I would also add that I think it's being able to add value to the issuer, right? So let's take a look at Apollo. They just made a recent announcement that they're going to work to create some, I guess, real-world assets with Securitize. But, does crypto have this liquid environment, or could it be used as, a new liquidity profile within capital markets? Yes, there's $130 billion issued already in Tether. However, I think it's more important to note, like, they need, one, being able to be comfortable in the compliance and regulations that exist to be able to enter this environment, which I think we're just getting into that kind of first phase or first evolution of that. But then thing two, what's the value that's added? And I think, like, creating liquidity for secondaries, right, or being able to use, let's take, for example, right, you trade on Binance and everybody trades on Binance. Everybody loves perps. It's a use case that's used that, transacts billions of dollars a day. I can now use a Apollo credit fund as a form of collateral where there are whitelisted and KYC'd liquidators within the singular exchange, and I'm earning 9% at the same time while I have the same exposure to my Bitcoin long or my carry trade. And now for the first time, I'm not using USDC or USDT and, giving that yield out to either Circle, Tether, or the team at Binance. I think that is really like a core optimization or an example of one that will essentially be taking these assets or these issuers and actually giving them the reason to come on chain.
Yeah, 100%. I agree. It's also, I think, like bringing the right assets, right? Kind of to your point, it's just like there's somewhat of an adverse selection problem. I think Athena's done really well because it's actually a good asset people want to invest in, and it's like a great trade. But then, I bring you some SME opportunity in a third world country that has no legal protections. Do you like that one or not?
Yeah.
There's a lot of different types of
loan to the bicycle firm, right?
And of course, like yield compensates for that. The higher the risk, the higher the yield. But at some point, like I think like bringing the right assets to the market, private credit issuances from really strong issuers, like that's all good. Collateral is important too, right? Because like as long as there's some collateral behind it, you have some safety. So I do think that's important. And to your point, like sneakers or whatever, that's hard to track. So you should be compensated.
It's the collateral, but also the liquidity of the collateral. Like if there's no liquidity, it's not really collateral.
Yeah.
So that's like the hardest thing. And then I think the other issue is also like, just because you can tokenize it doesn't mean it's a good idea, or that you're like, for example, like I'm going to tokenize pork futures, right? Like the type of person that's going to short or long pork prices is already a sophisticated investor. They don't want to go on chain, or unless you give them a really strong reason to. So it's just a matter of, okay, if you tokenize it, who gives a damn?
Right.
And no, but I sincerely am asking, who gives a damn? Then that's your customer. But the thing is, it's, a lot of times it's just tokenizing stuff for the sake of tokenizing it.
Yeah. No, I think curation could help solve that problem, right? Like, of course, we recognize that no one's trading pork belly futures on trade. Hopefully, I think, go ahead.
Yeah. Sorry. I was going to say, like, the asset is important, but I think, like, again, if you bring a real industry on chain, the composability is what's missing in the industry right now, right? So don't want to bring it back to domains, but today if you want to go do anything with domains, you go to GoDaddy and you do it. But that's it. That's the central source. Then you go to another person. And I'm sure it's the same with most digital assets. But once you bring it on chain, it is programmable. Now, for the first time, you can take a domain and you say, hey, I can rent you DNS rights for 1 year. I can split up my parking yield for 1 year, and then you can program it in 1,000 different ways. And this doesn't even need to have liquidity because you're guaranteed that income because it's on chain, right? The ads you're showing on your website are already like generating revenue. So the fact that it has intrinsic value of its own, sure, liquidity helps. In all cases, liquidity helps. But you're not trying to artificially create demand or supply. Demand and supply exist. You're saying, hey, what can I do to make it more programmable, make it more pluggable, so it can go into every single DeFi protocol on Earth without you having to think about how many hoops you have to jump.
I'd agree with that totally. Yeah, I think you hit the nail on the head there. The only other piece I would add to that from my perspective would be essentially like allowing at like the concept of prime is such a prime within the world of high net worth individuals is such a coveted, you know, if you onboard to a private bank, you can get access to prime services. And that essentially means, hey, you own a $5 million home in Florida, a $25 million apartment in New York. We'll lend against all of these assets collectively. The average Joe does not have access to those services in any way, shape, or form. And like at large, crypto could give those types of, you know, accessibility or composable nature to someone, you know, that's not in that vein. So I think that like there are a lot of great use cases that obviously we're still so early on, but that like a lot of these machines that we have built, which is DeFi in my opinion, which we're currently, you know, plugging Trump coin in and Dogecoin into, could really be the plug and play modules to plug in like real tokenized versions of actual assets that exist and create better solutions to problems out there.
Yeah, 100%. And maybe like just bring it back to like cross-chain and this idea of like accessing yields across. I mean, one question for you, Kenny, is like, what do you think are some of the structural limitations of being able to access, you know, RWA yields cross-chain, or through your perspective at LayerZero?
Yeah, I guess a bit of a blanket answer is really just liquidity access cross chains, right? There's always this issue with fragmented liquidity where you have an asset, you have different pools of that asset on different chains, and like you never really have like a central hub of liquidity. The second thing is like all these different developer features that they want to build into their token or into their protocol. Like, let's say I'm like an institution and I don't want my funds commingled with like assets that have been involved as some part of like a hacker exploit. I want to blacklist these addresses that are associated with that hacker exploit. Like developers oftentimes don't have the optionality to do that type of thing. So I think along those two, we're actually help solving both of those, right? With the OFT standard, which allows for liquidity unification across chains through like a mint and burn transfer with a single unified supply across chains. You essentially have the same asset in just different instances of that cross chain where you can pull them together. It's essentially the same asset, the same version of the asset you're getting on every chain. And then for like in terms of developer features, everything that we have on LayerZero is configurable, right? So we have things like whitelisting or blacklisting, rate limiting. These are all features that institutions and RWAs want to see built into their projects, and we're giving them a means to do so through like just developer configuration and modular security stacks in general.
And maybe a follow-up for the chain's perspective, or first off, anything if you want to add on that. Okay, no. Follow-up for you guys is like, what would you like to see, like I guess in that cross-chain implementation, which would be like most ideal, like for RWAs? From a chain perspective? From a chain aspect, yeah. What kind of like we talked about assets, right? So we covered like asset selection, liquidity, things like that. But if there's anything else you think from a chain's perspective, what would you like to see from like RWA side being delivered cross-chain?
Yeah, delivered cross-chain. I think that what a lot of people lose sight of is like there can be a lot of permissions set on a chain level. And to be clear, I'm not technical, but pay a lot of attention in a lot of these meetings. And a lot of the permissions that are set are usually local to that network at hand. And once they leave that network, they're now essentially like this new potentially fully permissionless token. And I think that, that's kind of the whole point of LayerZero and what they've built is an interoperability solution that allows you to maintain those controls. And specifically when we're talking about an asset class that's, very centric to permissioning, permissions, KYC, KYB, AML, all those different types of things, being able to carry those same properties from their issuance chain to their destination chain, which, where they can be used, I think is probably the most important piece that we've seen.
I can say, so the elephant in the room from this perspective is that every chain is fighting for the same liquidity. Now let's assume, of course, we're going to grow the pie, but how many can it fit in a bakery, right? So there's going to be a finite number of pie, right? TVL, whatever it is, RWAs, and every chain is fighting for it. So there's a certain level where if you're the issuance chain, you actually don't want it to, unless your North Star is like, we want to tokenize as many assets, and then like a bird, you let it go fly onto different chains. That's the only reason, that's the only way it'll actually work long term, because if not, then we're fighting for the same liquidity. So if the issuing chain also wants to keep the liquidity, then you kind of want to close the gates in a way. So the real thing is that no matter what you tokenize, everyone's fighting for that same liquidity. And the main way I see this working is, I guess Securitize kind of does it because they don't have their own chains. Like, we'll tokenize everything. It has its own set of issues. But my point is right. Obviously, but like in an ideal scenario, it'd be like, you tokenize, coffee futures or something like that on Plume. Then that asset has a shit ton of liquidity on movement, and then we incentivize it. People start borrowing, like trading, use it as collateral. That's how it would work. But in the reality is that if, for example, Plume was like, over my dead body, it's not going to leave my chain, then that puts us in a tough situation.
Yeah, I completely agree. Like the assets, the liquidity on Web3 is a fixed pool, whether we like it or not. The assets have to go on all chains, and you just can't be like, oh, if you need to tap into this RWA, you have to come to this chain. That's just not going to work. But the other user experience scenario that I think of, people already use existing Web2 platforms to do the research, to do the buying and selling. They actually don't care about where the asset is sitting. Let's say you say, hey, I want to invest $1,000 in domains that are generating 15% parking revenue or advertising revenue. They're not going to say, hey, go look for liquidity on Base, go look for assets on chain Y. They're just going to say, I just want to make money, find me wherever the assets are. And if the asset issuer is like, no, these have to be on my chain, maybe that works too. Maybe it doesn't. But the point is, the user really doesn't care. As crypto, we have to just accept the fact no one gives a shit about our chain. They just want real yield.
Yep. Yeah. Agreed. I think one of the big things around it is if you do have that ecosystem where you're using these RWAs, that becomes such a big defensible position, right? Like if you have the lending and borrowing market and you have that specific RWA, whatever it is, call it private credit, call it whatever, but if that sits on your chain and people are actually borrowing against it, using it and doing these whole DeFi loops, that's such a moat that I don't think we could ever take that away. And of course, I don't think anything like this should be very combative. You guys are doing your thing. You have all your chains which are pursuing a different narrative than we're pursuing. Delivering this to you is just one of the ways that we can work together. And yeah, I definitely don't think we won't shut it off.
Yeah. No.
Not doing
that seemed like a political press conference there. Enjoyed it. But with that being the case, yeah. So with that being the case, I would agree totally, right? At Injective, we are working around the clock for as many native issuances, whether that be in the world of stablecoins, whether that be in the world of real-world assets. But at the end of the day, our bread and butter is creating finance-based modules to plug these assets in, and we want to have access to as many places as possible. So, assets coming from Plume Network, we know that these guys are probably leading the charge at the moment in terms of having the most, native real-world assets. We want to create a strong partnership with them such that, we can leverage those assets on our chain and plug them into our, as you noted, defensible and what we believe product offerings that add value that will cater to users. So we're very excited about what you guys are doing with Starlink, and it's great that you have Kenny here as well, who can make sure that I think that the most important piece is being able to get the asset in the right way to the destination chain, and very excited about it.
Yeah, 100%. I think what you guys are doing with the domain side is actually pretty interesting too, right? Because that's very much singularly focused, and there's such a good Web 2 based economy for that. And I'm excited to see how that plays out in general. Yeah.
Thanks. Yeah, no, I was just going to say, domains just end up being digitally native. But the other thing I was thinking is chat.com sold for $30 million. I can't afford to buy chat.com. There's no liquidity. You cannot use it as collateral. You can't find a buyer for chat.com. But what is crypto good at, right? Finding ways to split up chat.com. And that's what we want to specialize in, right? Hey, how do you take this asset but make it composable? And then coming back to the multi-chain question, those fractions are going to be sitting on 1,000 different chains. Price discovery will be happening on 1,000 different chains. But if I can buy $1 of chat.com, just like I can buy $1 of an Apple stock, it actually helps the liquidity because we're not like in this trapped ecosystem. Will it be applicable to everything, every RWA, every domain? Probably not. Most of them will remain illiquid and useless. But the certain valuable assets will emerge.
I realized what I was going to say was going to sound even more pessimistic, so I'm not going to say it.
All right.
It's not pessimistic because the thing is, like, you know,
Just say it.
No,
Just say
it's-
it. At this
It's not
point.
that. It's like the juice has to be worth the squeeze, right? So it's like, imagine you have like 3 first edition Charizard cards, right? Pokemon cards. And you're like, I want to borrow against it. Okay, cool. But like now you're going to have to take this and send it to a third party
Right.
that has to be trusted. What if that whole thing, a fire blaze, you know, someone flamethrows it, right? No pun intended, sorry. And like there's not enough insurance or something.
Yeah.
What's going to happen, right? So there, like the thing about being on chain is that everything is on chain and it's enforceable. Like, you know, code is law. But when code isn't law, then what do you do? But if the market's big enough, you'll always find a way to do it. But the thing is that for most, at least for myself, I think about retail. Institution will always have the whole world as a financial playground. They can find ways to put money in the left pocket into the right pocket. But for the retail user, like the normal person, they don't have a $20 million house in Malibu, right? They might have like one Babe Ruth or Mickey Mantle card and like, what can I do with this thing? So if we can enable those people, that to me is like the most interesting.
Yeah, yeah, for sure. I think those are good examples of things that need to be like, you know, done in a proper way. Like you're right, you do have to send it to a third party. They have to have custody. There should be insurance and all that. I think there are a lot of other interesting assets that, you know, you'd probably be okay with. Like real estate's like a good example. You could always like claim the deed or something, right? And there's some legal process that's set out. And then also it's like, you know, talking about liquidity, I feel like there is a subset of users that you could attract that is like okay with less liquid stuff, right? Like if I were to tell you like, hey, I had this great SPV for this hottest hit, like, you know, VC deal that you wanted to get into, you're probably okay locking up 10 years. You're like, whatever, fuck it. If either this is you know, 20xing or this is like going to zero, I'll accept those terms. But you know, you just have to be, I think, a little bit, rewarding that risk profile enough. So I do think, you know, overall, you're right. Today, we're fighting for the same source of capital, but I do think, optimistically, that there are new capital sources that we're attracting in, right? And that's what I think the RWA narrative is about, being able to step one foot outside what's traditionally offered in crypto today.
No, totally agreed. I was going to talk about, you know, more of the optimistic case in this setting, and that's, you know, Anthropic just raised at a $61 billion valuation just a couple of days ago. There are several seed investors that are in it. Let's say $100 million valuation. They're up 60x and they're completely illiquid. But in that same sentence, there is a whole group of users that don't have access to Anthropic and would like access through Anthropic. So I think that, you know, some projects that we're working on that are quite interesting are taking those types of assets, you know, putting them into an SPV, putting them through issuance, offering them in a secondary market, finding a liquidity provider who is always willing to essentially pay a risk premium to take over a position. And now you have a liquid marketplace where anybody can swap in and out, you know, with paying some premium into or out of, you know, Anthropic, and it's kind of a liquid secondary market. So that is something that I'm super interested. I think that's bringing quote unquote Wall Street to Main Street, but we'll see kind of how that evolves. And there are a lot of pieces there.
Okay, I'll say something optimistic. All right, like I think real estate is a big one, like REITs, right? So like for example, I'm a kid, let's say whatever in some other country, and I want exposure to United States real estate. I don't have a real way to actually buy it. So if I'm able to get a tokenized REIT where I don't, and again, I don't want to take the risk of a particular house on a particular street. I'm just like, I want to go long San Francisco real estate. That's pretty freaking cool. And then let's say I end up building a big position, I can borrow against it. That to me is actually really cool. So I think on the real estate side, that's much more interesting if it's already an investment vehicle. So that's the type of thing where like now someone was telling me they have a real estate-backed stablecoin. I didn't get the mechanics of it, but like, but my point is that like when you have assets like that, then you can do things. So that to me is actually pretty interesting.
Yeah, 100%. All right, I think we're at time here. This has been great. Like honestly, like I had a bunch of questions. I didn't use them at all. I was kind of just a riff raff with you guys, so more like a fireside chat. So this has been really fun. Big round of applause for these guys.
Thanks for having
here.
us.
Thanks for coming.
Thank you.